Okay, let's talk about portfolio performance. In this worksheet, what I essentially have done is that we have two portfolios that we're going to look at. I've gathered this data from historical data. It is in monthly data context. So this is actually an average of 0.18% per month over the time frame. So we're looking at monthly kinds of data here. So the risk-free rate I had is 0.18. Here are the betas. You notice that one of the betas is negative. The portfolio standard deviations, obviously that comes from a calculation. Again, all this data comes from an analysis of the company itself or the stock market itself. So as we look at the ratios, as we look at the different techniques of managing or measuring performance, the first is the Jensen Index. The Jensen Index looks at the CAPM market returns, should be 0.185%, and the actual rate of return for this stock was 1.36%. So the Jensen Index measures 1.175. So we're doing better than the market in general, but when you compare that to asset B, we can see that asset B has a lower Jensen Index. So it's saying that B does a worse job of performing. It doesn't do as good a job, if you will, as A. Both are outperforming on a risk-adjusted basis. Both of them are doing better than the market. However, A is better than B. What about the trainer index? Look at the trainer measure. The trainer measurement for the market is negative 0.5. Again, this just comes from the fact that in this case, the portfolio beta is negative. We ultimately, that is a challenge for us in the end, and and also the actual rate of return for this market is negative. So the trainer measure for A is negative 118 versus negative 0.5. This is saying that the trainer index is doing worse. And then, of course, over here, it's saying that the trainer index is doing much better. So, again, A is better than B when you think about the portfolio. They're both better than the market using the Jensen Index. However, trainer is worse than the market. Trainer measure for B is better than the market. What about the Sharpe ratio? Again, when you calculate the Sharpe ratio, the measurement for the stock market, it should be negative 1.11. This is just the ratio of return to risk. For A, the Sharpe measure is 0.19, which is obviously better than negative 1. For B, 0.25, obviously better than negative 1. And this also tells us that portfolio B is performing better than portfolio A, or asset A. The Modigliani model, M squared, the M squared for our fictitious stock, or under M squared, remember we created a fictitious portfolio. The rate of return of that should be 0.2, but the rate of return on the stock market was negative 0.32. So obviously the positive is better than the negative. So it says that A is outperforming the market. It says that B is outperforming market, but it also says that asset B, 0.29 as an M squared, is obviously greater than 0.267. So again, this data is slightly skewed because of some of the information being negative, that being the portfolio betas, etc. So let's change this real quick, see what happens. Let's make this 0.02, so we at least make beta positive. Let's change the stock market return to 0.0032. So that gives us 0.32% for the market. So now we should have some information that at least looks a little bit nicer to review. Again, A is better than B. Trainer measure. They're both stocks are now better than the market itself, which also means that A is still in this case better than B. If you look at the Sharpe Index, again, the market's 0.31, but the Sharpe measure for A is bad. It's negative. It's less. It's also less for B. So the Sharpe Index says that these two assets, using the Sharpe measure, which is a risk-adjusted measure, are not performing as well as the stock market is. And then finally, if you come down and look at the M squared information, 0.267, 0.290, in this case, they are both performing worse than the market. So in this case, we'd say that these portfolios in general look like they are underperforming the stock market in this case. So again, I think that the takeaways from here is, obviously you're looking for bigger numbers. You want to perform whatever the market number is. We want a number that's bigger than the market number. However, we also have to understand that in real life, real data sometimes makes it difficult to make what looks like logical analyses. So again, that's how we can measure the performance of portfolios.